Welcome to Power CEOs, the truth behind the business. I'm Jen Goday, your fearless host, investor, entrepreneur, and business strategist. Why are we here? Because iron sharpens iron, and when we bring industry leaders and successful entrepreneurs to talk about what's working in business, and maybe even some of what's not, what we're able to do is learn and grow. As a result of implementing this, our businesses will grow, and the ripple effect impacts not only ourselves, our teams, and our families, but also our communities and our world. You are in for a treat. We are here in studio in Houston with Holli Moeini. She is an amazing power star in the business world. She is a fractional executive. She's a CFO. She has a lot of experience in mergers and acquisitions. And we're going to talk all things financial health, how to set ourselves up to exit a business, how to maximize our greatest asset, that is our business, and so much more. I'd like you to welcome to the studio, Holli Moeini.
Thank you, Jen. Thank you for having me on Power CEOs. I'm excited to be here today.
I'm super stoked too.
We're going to have a great conversation.
We sure are, because this is something that has been coming up so frequently. I get questions all the time. Hey, Jen, I want to exit my business. What do I need to do? And I look at it as a business coach and I say, okay, well, your financials are not in order. We have to get some things in order. And I'm always referring to people such as yourself. And so, Holli, let's talk about the financials in a business.
Yes.
What are the things that we need to know? How do we know if our business is financially healthy? And if it's not, how do we get there?
Okay, let's go to the basics, Jen. I love this. I love this question. So there's an epidemic out there with CEOs, an epidemic, and I'm going to tell you what that is. So all CEOs love to look at their income statement, right? They love to look at their revenue and maybe not their expenses, but definitely their net income, right?
Yes.
Okay, so, but they never look at their balance sheet. And so I'm going to frame this up as you want to be a healthy person and you want to be personally healthy. You go to the doctor and you get checked out physically. And let's just say you keep going to the doctor. Do you know you're really healthy? Well, you need a blood test with that. They go together. Not only are you physically looked at from the outside, but you're looked at on the inside of what's going on. So the balance sheet and the income statement go together. So let me reframe this one more time if it's not exciting enough for you, because I'm going to make it exciting by the end of this. So every CEO needs to go look at their balance sheet. And so I was trained as an auditor for almost 10 years. And what we did as an outside auditor, a CPA, we would validate your income statement. And we spent 90% of our time where? On the balance sheet. Okay, so why this disconnect? And there is a disconnect. And so what I always say is there's an epic love story going on between the balance sheet and the income statement. You cannot have one without the other. And the reason why I say this is because we have an issue where bookkeepers, when they don't know where to put something, it goes on the balance sheet. We also have small to medium-sized businesses that are looking at exiting or whatever they're doing. They use QuickBooks software. What happens? There are suspense accounts. So what happens is that those expenses that should be reducing your net income are sitting on the balance sheet. So here's the mic drop moment on this, is that if your balance sheet isn't right, your income statement isn't right. You do not know your net income. So it's an epidemic. And so from financial health is like, everybody go look at your balance sheet. If it's a mess, it might be time for a new accountant. That's what I'm going to say.
Absolutely. And you know, I'm going to actually ask you about this, because one of the things that we recommend to all of our clients, and we do this regularly, is if you have a CPA or you have a company doing your regular bookkeeping and your regular accounting, every couple of years get an outside audit, get an outside second opinion to look, because maybe we don't know. I'm not a CPA. I don't know the intricate details of accounting. I trust those professionals to do so, but sometimes we might not know what we don't know. So what are your thoughts on getting that independent second opinion every now and again on your books, for example?
Well, 100%, Jen. Okay, so most of my clients that come to me, I'll say, yeah, they'll say, everything's great. Like, I've got everything. And I look at it and it's a mess. And so I think that you should go out and get a second opinion, particularly if it's okay to not be, knowing every single number on the balance sheet. You're really knowing how to read it. I mean, it's good to learn it, but you don't have to be an expert in everything. You're doing your thing as a CEO. If that's the case, hire the experts. But if you want to learn it, that's always good too. And I think you have to make sure that you have the right people doing your accounting and giving it to you timely and it makes sense. And so that's really important. So I always see a mess. And so yes, I would say it's really important if you're listening to this right now that you think about it, and it's not that costly. If you get a CPA and audit, that's expensive. But if you get somebody who's outside that you trust to look at it, that's less expensive.
You know, I look at it kind of like it's also a fresh set of eyes, right?
100%.
You know, there's a lot that goes in. Engineers look at quality assurance. They put it in front of new eyes that haven't been involved in the project. I think it's the same way with accounting and with our financials and our books.
100%, I agree with that. Absolutely.
And so as we think about this epic love story between our, you know, income statement and our balance sheet,
they go
for
together.
example,
Mm-hmm.
what are some of the things that we as entrepreneurs, maybe we're a small business, maybe we have, you know, 1 to 10 employees, maybe we're starting out or whatnot. What are the most important things for us as entrepreneurs to be paying attention to?
All right, so outside of knowing and making sure you look at your balance sheet, I think that you need to focus on the income statement and focus on making profit. And that is the first thing that we need to do is make a profit, and you actually should know your numbers and look to your unit costs. You really should go back to like, what does it cost to actually, you know, provide my service or my product or whatever it is, and look at that level, and then make sure that you're meeting or exceeding a 10% net income is the floor. If you're not, then it needs to be retooled a bit, and maybe getting some advice is good. And also, this is the other thing that I see in when we talk about M&A, we're going to talk about it, or exiting, where the CEO doesn't pay themselves a salary. Well, if you don't pay yourself a salary and you're working in the business, that's an issue. You don't really have, and you think you have 10% net income, you don't have 10% net income because you need to pay yourself a salary, or a buyer would have to replace that. So you need to look at your numbers, improve your profit, and make good decisions in that way.
You know, one of the things that we talk about a lot on this show is knowing your numbers.
Yeah.
So you know I'm bringing these people in because this is my soapbox. But part of knowing your numbers is knowing whether it's a lagging or a leading indicator. And our financials are a lagging indicator. Mm-hmm. So if we know that financials are something, we're looking at a snapshot of the past. Mm-hmm. How do we then look at that and understand how to make tweaks in order to improve our profit margin, for example, in the future?
Yeah, so you have to look back to be able to improve in the future. And so if you end up going back to your, income statement, going back to your unit costs, and then look, is it in cost of goods sold? So another thing is that the books aren't categorized so that you can really figure out what's happening. So the things that are directly related to your product or your service or whatever you're selling, to your revenue, should be in cost of goods sold. So that needs to be broke down to the unit level. So usually I see pricing issues there, or costs are too high, or something's happening there. And then everything below that cost of goods sold item is SG&A, we call it selling, general, administrative, and then those expenses need to be very low. So when you and they're normalized, and they're not scalable based on what your revenue is, that they can be more normalized. And so those are the easiest ones to fix if those are out of line. But like, you have to look at every category and look at fixing them, and that's what I would do.
And you know, like if you're listening to this, you're going, "Oh my gosh, there's so many lines on my statement." You just have to start. Like, I like to look at it as, okay, what is the least overwhelming thing for me to do? Yeah. I'm going to look at, if I'm making hamburgers, how much does it cost to make that hamburger? And if it costs me $2 to make that hamburger, but I'm selling it for $1.50, it doesn't matter how many more hamburgers that I sell or how much I put into marketing, I'm still losing money. And so I think that is really great that you brought that up. Pick one area and optimize it, and then move to the next. And it's really good to work with professionals such as yourself on this, because if you're a CEO like me, or you're looking at the strategy, you're looking at the big vision, and you're driving the company, we partner with our CFO, who brings hey, this is the dollars and the cents, and this is what is possible. And it really is a partnership. So how can we look at these conversations with our financial professionals? Yeah,
absolutely, 100%. You actually need help to look at these types of things. So I've had one client that came in, and if we would have gone to the hamburger and the unit cost of the hamburger, I don't know that we would really have gotten it. We had to go by customer. And then we found the problem in the customer area. So it just depends. But working with an expert will absolutely 100% help you get there and give you the tools and the strategies to figure out what little tweaks can we do. And we scenario plan, so we can look at it, scenario plan. If you just do these little tweaks, what will result in your net income increase? What will happen to your cash flow? And those are all good things to have. So I like forecasting and playing around with, well, if we change the price X amount, how much would that, and would we lose customers? So we need to go through this whole entire
exercise.
Yeah, you got to drill into the details. I mean, there's just no doubt about that. But getting help, even if you're good at the numbers, getting help to actually have a different perspective is very important.
Yeah, and as executives, if we're successful in business, we're high risk takers, and traditionally our financial advice and our CPAs are not. So it's really a good checks and balances for us to have. We do have to take a brief break, but we will be right back after these messages. Welcome back to Power CEOs, the Truth Behind the Business. If you're just tuning in, we are here in Houston live with Holli Moeini. She is a financial executive. She has been through mergers and acquisitions and has a tremendous wealth of experience. We started today talking about the epic love story between our balance sheet and our income statement. Yes, I know it's not sexy, but the reality is we need to know our numbers and we need to know the breakdown in order to see how we can make improvements as we move forward. So Holli, I want to dive right into our business is our greatest asset.
Yeah.
And this is coming up frequently. I can't tell you, probably 30, 40 people per week are reaching out to me because they want to sell their business for a variety of reasons. Some of them are in trouble, some of them are burned out, some of them want to retire, some of them are just done. They want to do something different. There's all these reasons why they want to sell their business. When we want to sell our business, what are the most important things for us to think about?
Oh, gee, Jen, plan early, okay? Plan before you want to sell.
Oh, so no fire sales?
No fire sales. Okay, so plan, as soon as you have a business, if you don't have a plan right now, you need to plan. Okay, that's it. So, but let's say today you are in the situation that you just said, I want to sell, I'm done, what should I do? The first thing you should do is make sure that your financial statements are in order, okay? And that you get if you don't have a good accountant, you get a professional in to make sure that they are accurate. That's the first thing that buyers are going to look at, and how profitable you are. And so I think that just putting blood, sweat, and tears into it, it doesn't qualify for a price. So you want to get your EBITDA, earnings before interest, taxes, depreciation, and amortization, but that's called, EBITDA, and you want to get that up as high as you possibly can. And so when you work with a professional, what I see is there are accounting opportunities, not sexy, but there are opportunities that exist where there's been bookkeeping where you write off things that are greater than a year. If something has a useful life greater than a year, it needs to go on the balance sheet again. We just talked about that. And be written off as depreciation or amortization. And then it never hits your EBITDA. So it's an uplift in your price immediately. I had one such company that came to me that I was looking at their books, and they got a bunch of, they programmed their own technology to send people out in the field, and they were using this, and they paid for it and expensed it. And I'm like, that should be on your balance sheet. So we improved his his EBITDA by X percent, whatever that was, immediately. And so that's important. If you have lease expenses and you can buy your equipment, this is a classic one for trucks and stuff like that. If you can buy your trucks instead of leasing them, it's an immediate uplift to EBITDA. So there are accounting things to do too. So get your house in order as far as your financial statements, because people will be pouring all over all of that in due diligence. Everything needs to be reconciled. That needs to be ready to go. Have your story. Tell your story about growth. Mm-hmm. And have it make sense with your numbers, because oftentimes I've heard stories that I'm like, I look at your numbers, I'm not seeing that. That's not the story I see. So have everything really tightly packaged so that you can entice a seller or a buyer to come in and buy your business?
Well, I wanna go a little bit deeper into this because this comes up frequently, and
Yeah.
I buy businesses. That's one of the things that I do. I buy them and I sell businesses. I have multiple. So when we're looking on the buy side, one of the first things that I hear is, and I've done my due diligence already. For example, if I'm buying, pick your company, like let's call it accounting.
Yeah.
I'm not currently buying accounting firms, but if I were to buy accounting firms, I would look at what are accounting firms selling for? What are the comparables for accounting? What is the multiple of EBITDA, for example, of accounting firms? And so I, as the buyer, know that, oh, maybe, pick your multiple. Let's just use easy math. Okay, let's say that if I have a $10 million EBITDA company, it sells for a 10x multiple. That is not the case. These are not the real numbers, but we're going to do easy girl math on this show today.
I love that.
So we're going to say that I have 10 million in EBITDA and it's a 10 times multiple in whatever I'm buying. And then I go to somebody who's selling and they want a 20x multiple. And they have it listed for 20 times, which is not what the comparables are selling for, but darn, I put my blood, sweat, and tears and 24 years into this, and you should pay me this. We're never gonna come to that accord because it doesn't make sense to the buyer. How do we get past that?
Well, I never say never. Okay,
Oh,
so that's
okay.
the first thing. So like if you really love this accounting firm, this is what I would do. There's a few things I would do. I would still go for it, even if they want 20 times. And it depends. If they're working with a broker can kind of help educate it. So oftentimes they're not educated. So they just think just like you said, it's worth this much. So there's an education component that goes down the parallel path of closing, okay, and negotiation. So the other thing I do is I do something that I negotiated differently. So let's say I do think and I hate math on the fly, particularly when I'm on TV, but like let's say that we're doing, they wanted 20 million and you're willing to give them 10. So let's say you give them 10. And then you do an earn out on a different portion based on whether they hit higher earnings. So you're making more money. So it's a win-win, and then they're getting more money. So you can do an earn out over a portion of years with them, and then you can repackage how they're looking at it. So maybe I give you 10 million of cash, you get an earn out that you can get this if you achieve these numbers, and you're happy to give it if they achieve the numbers. In this way. And then the other thing they don't look at oftentimes is they don't realize that they get to keep their cash. So most transactions, not all of them, but most of them are cash-free, debt-free, right? Mm-hmm. And so when you say, okay, well, you get to keep this cash, and then you get this cash from Jen, and then here's your earn-out potential, you somehow close the gap. Got them down a little in their eyeballs, and then close the gap. And so I've done that successfully in the past, and it does work. And earn-outs, people hate them. I'm going to tell you why, is you have to be crystal clear with the seller on what you expect them to deliver, and then make sure they have control over it. And then make sure you check in with them I would check in every quarter with every one of my earn-out people to make sure they understood what's happening, what do I need to do to meet my numbers, and we work together to meet those numbers. So it's not them against us, and they got the control. So that makes an earn-out. I haven't had a bad earn-out when that is worked with.
Okay, so I'm going to ask the next question. I'm sure you know what's coming. We know each other quite well. Full disclosure, Holly and I know each other a lot. Yeah. We align a lot, and I'm throwing some scenarios out that she knows that I would never do in real life. Anyway,
okay.
But let's just say that I understand that I understand, Holly, that my business you're saying is only worth $500,000, but I need this. This is my retirement plan, and I need $5 million. As a seller. As a seller.
Well, then you better have called me a long time before that period of time so that we could work on getting your net income and your EBITDA up. That's the only way. You have to bridge the gap with either education or there's some negotiating room, maybe not that broad of a gap. We stretched it a little bit, Jen, with those numbers, but it's either that or you plan early. And let's go back. Let's just circle back and just say, exiting the company, just when you start your company, have a plan. You should know where you're going, and then you can work towards that plan. And so it's never too early to exit plan. So
And something else that I encounter a lot is they have no succession plan. They have no exit strategy. I'm going to work and this is my baby and I'm going to work forever, but we still need to have an exit plan and a succession plan because we don't know. We don't know what tomorrow holds. I mean, like, heaven forbid I go and I'm not able to function. I'm going to give you a perfect example. Last year I was concussed. I could not function for months. So if I didn't have a succession plan, if I didn't have everything in place and have the ability to exit my role in the company, my companies would have gone under.
Well, 100%. And the other thing I'm going to say about that is when a buyer comes along, so if you're wanting to sell your company, you better succession plan because a buyer does not like it when all the eggs are in your basket, Jen. So they would have looked at that if you didn't have that support and that succession plan. They would look at that poorly. They'd be like, okay, well, we're second in command. What would happen if something happens? And the risk goes up. And then what happens when the risk goes up? The multiple goes down. Yeah, the price goes down. So there you go. So that's another reason why it's really important to not have all your eggs in one basket and diversify yourself as well.
So if you're listening to this, I just want to really briefly wrap this up because we are going to have to go to commercial shortly. If you are in business, the best time to exit plan is when you start your business. If you're already in business and don't have a plan, today is the next best day to put your exit plan, your succession plan in place. Even if you don't intend to exit, it's important that we have that in place for anything that might transpire. And who knows? We don't know. Something might happen. We might need to exit our business unexpectedly. If we don't have key personnel in place and succession plans for our key personnel, then we're not going to get the most out of our business asset. And we deserve to get the most out of our asset because it's our blood, our sweat, our tears. And how do we know if this is in order? By hiring the right financial professionals beside us, by hiring the right team beside us to make sure that we're able to grow fundamentally sound, and we're doing it in a way that's going to make sense when it's time to do that exit, to sell that business, or to maybe we want to retire to pass that on to our next person. It's so important that you start this today. That is your first action step for me today. I know Holli's going to have a whole lot more for you, but that's kind of in a nutshell what we've been talking about. We're going to hit mergers when we want to buy a business, when we want to acquire, and when we want to grow that asset after the break. We'll be right back. Welcome back to Power CEOs, the truth behind the business. If you're just tuning in, you're going to want to go to nowmedia.tv, click on shows, click on Power CEOs, and watch the first half of this episode. Why? Because we are here in studio with Holli Moeini. She is a financial executive. She has worked tremendously, many mergers and acquisitions. She's an expert in that financial space. And we as CEOs and entrepreneurs generally don't like to look at our balance sheets and our numbers. So we rely on professionals such as herself to bring that enlightenment to us to help us to move powerfully forward. We have talked about how to be financially healthy as a business. What do we need to be considering as executives and leading these ships? We talked about exit planning. When's the best time? When you buy your business or start your business. If you are sitting here today going, I don't have a succession plan, well, today is the next best day to start that process. It is incredibly important if we want to maximize the asset that is our business. And I want to shift gears now, Holli. We're going to talk about something that is really smoking hot in business right now, and that is mergers and acquisitions. Growth and accelerated growth through acquiring other companies. Once we are financially healthy and sound on our own and we've kind of squeezed the juice of the lemon and we've got that growth curve underway, adding those purchases, what is the most important thing for someone looking at mergers and acquisitions to grow their business? What is the most important thing for them to know?
Wow. Okay. So that was a great summary, by the way. I love that so much. So one of the first things that you should do in the very beginning is do it quick and fast and save time and money. So that means, like, we all know that when you're buying a business, it's about relationships, right? So we're cultivating a relationship, and then we get to the numbers and things fall apart. So this is what I'm seeing. I'm seeing, like, we spend time breaking bread together and having fun and learning about one another. Then we get the financial statements and we're like, okay, well, we wouldn't buy them. And so the first thing is, like, fall in love fast and start figuring things out very quickly so that it's quicker and easier to move on if it doesn't work. And moving on isn't necessarily bad. You say, hey, hey, if you change X, Y, and Z, I'd be interested in buying you. So, because oftentimes I've had people come back around, so I find it as a service when I do look at a seller that I'll give them those tips, what they need to do to fix themselves up so that they can be ready to be purchased. And oftentimes they come back around, but that's the first thing. Do it quick, do it early, and here's the other thing. Because I am a CFO, I have to talk about accounting. Okay, so when we are building our relationship, I say get the themes that inform once you get the numbers. So figure out the themes that are going to inform you. So for example, does the owner that you're talking to pay themselves compensation? Is it recorded in the financial statements? These are things that you find out just as talking, because I'm seeing this, Jen, in my practice right now, that people bring me something, it looks good, you have 10% or greater net income, and then once you reduce it for the salary, there's nothing left. Mm-hmm. And so this is again and again and again. So you got to figure that one out really early. And then look, we talked a little bit on the last segment about accounting opportunities. Talk about their business, figure out their business. And then the other one that just trips my buyers up again and again and again is the structure of their accounting. Okay, I'm going to talk about accounting. So let's say you're in business and you're buying a bookkeeping, but you do real estate on the side and you run some house sales through there, or
keep it clean, folks. Keep it clean.
But the structure isn't. In fact, one deal, it took me a while to figure out that they were splitting employees between another one of their companies and the company that we were trying to buy. And I'm like, okay, figure out what is really happening before you actually even get the numbers. You can make it quick. And that is one of the very concentration of customers, related party transactions, all these things. We're having a conversation. We can talk about, you own the building, and these things are normal conversations while we're also bonding.
Mm-hmm, absolutely. And I want to just point out, it's so important that this comes out very rapidly before we start paying professionals, because guess what, folks? Holli isn't cheap.
I was going to say, you're right about that.
And anybody in your legal and your financial services, that's going to be your biggest expense, really, in due diligence. I buy businesses, and it's my job as someone who's going to buy a business to do a lot of that due diligence before I bring in the financial team, the legal team, because if it's going to be a hot garbage, it was sold something and then I see 3 years of financials and it doesn't make sense with what the bill of goods I was sold, I need to be savvy enough as the entrepreneur to say, nope, something smells rotten in Denmark here before I pay other professionals to come in. And so as we think about this, Holli, I'd love you to share, because I know your field, when is the right time to bring a Holli in? A fractional CFO, the financial due diligence. When is the right time to bring you in?
Okay, I love that, but I have to go back. I mean, you're making me laugh. I have to go back to. You're right. It is a shit show. Like when that happens, the issue with the accounting is that oftentimes buyers want to go straight to a quality of earnings. A quality of earnings is going to cost you a lot of money. And so you don't want to go straight there. You got to figure everything you just said, you got to figure that out first. And so it's much cheaper to hire a Holli if you don't have that in your basket of professionals that you work with right now, to figure that out soon before you go into a quality of earnings and they rip it apart and you still have to pay 10, 20 grand. It's a lot of money. And so the right time is if you don't have somebody on your team that can look at the financials and come to the conclusions that we are, or then that's the right time then, okay? Or when you're down the line, you want to do a little bit more proving of the numbers and do a quality of earnings. And a quality of earnings is from an outside CPA. They do it. And the important thing about a quality of earnings is that it's not an audit. And it is performed by a CPA, but it's not an audit. And so what they really do is they're validating your EBITDA and looking at forecasts, and they are giving an opinion based on that. They don't even give an opinion. So there are no standards that require them to do anything. It's best practices. So it's not an audit. An audit has to do auditing standards. What's important in that point there is that you can customize your quality of earnings for you. And it's best practices. And you can work with your CPA firm to actually do that and cover the areas that you want to have covered. So that's really, and that can help reduce your fees as well. If your accounting's in order, if their accounting's in order, that can reduce the fees.
And so it's important to have the right team at the right time. And what I'm hearing as well, and we've talked around this a lot, is our perception as a seller sometimes isn't the real perception. We have an idea of our business, and our buyers are coming in and they have an objective pair of eyes. So it's really essential on the sales side that we have that objective. How do you feel about sales side getting this QOV or having an understanding of that?
This is the best question because it's like, if you're going to go sell your car, wouldn't you want to know what it's worth before you sell it? Everybody should get their own quality of earnings beforehand. To make sure that they are not being taken advantage of. If you don't do it, you will absolutely 100% leave money on the table, 100%.
So as a seller, you want somebody coming in and doing that quality of earnings. You want to know what it is that you're looking for. And on the buy side, you're going to, like as a seller, you have to expect the buyer to do it because it's just common practice. And so as we move forward, because we're almost at commercial again, I want to ask you, what is the biggest mistake that people make when they're buying a business?
Well, the biggest mistake they make is falling in love and not being able to walk away. That's the biggest thing, because if it's not meeting your metrics, and that's why it's so important for you to create, what am I looking for? And these are the basic metrics. And if they are missing, so what happens oftentimes is you go through some sort of soft due diligence and you find, or quality of earnings, and you find it's not hurdling what you wanted, and you don't want to, you can't negotiate the price anymore. You'll still go through with it, and that's the biggest mistake. And so I think that
it's a business killer.
It is a business killer, and two other things though, like cultural, like not really understanding the culture and investing time in integration planning. That should start from the very beginning. And then having your accountant overestimate the synergies. Oftentimes we say, oh, we're gonna reduce our costs by X amount, or our admin expense by X amount, because we have double doing. And that doesn't usually transpire either. So those things you gotta watch out for.
Absolutely, and I'm going to add one to the list.
Yes, please.
I'm going to add to the list, not having the right professionals on your team. You need a solid business coach if you don't understand. You need a great attorney. You need someone who only does mergers and acquisitions when you're looking at exiting or buying business, because a generalist is not going to have the same level of expertise, and it's going to take them longer and cost you more in the long run. And the right financial
100%.
professionals. You want the right team on your side. Why a coach? Well, because you don't have objective eyes on your business. That's going to help you along the way, help you to be prepared so that when you are doing the financial due diligence and legal due diligence, you're not spending more money than what you need to, because you've already filtered out the garbage, so to speak. Yeah. So Holli, before we break, the number one step for people to take if they're thinking about buying a business.
The number one step they should take is make sure their business is in order before they buy. Foundation has to be strong, has to be ready to be scalable, and have that new company come in, and that is really important. You have to be really honest about what your business is. That's the most important thing.
I couldn't agree more. So foundationally strong before we grow and add others to the mix. We are going to be right back after these messages. Welcome back to Power CEOs, the truth behind the business. We are here with financial executive dynamite, Holli Moeini, and we have talked about how to get our financial house in order as a business. We talked about what does it look like to be financially sound. We talked about exit planning, exit strategy, and how today is the day. If we don't have a succession plan and an exit strategy in place, it's today that we want to think about this and get this in order, not when we want to sell, because then we'll end up with a fire sale. And we talked about when we are growing and we are fundamentally sound and we want to look at growing by adding a business, or we want to look at purchasing a business. What are the things to consider? And now we're going to dive right back into our topic with Holli. And Holli, in the break, we were talking about things, and I'm going to ask the question I asked you first, and that's, you have done due diligence on over 50 transactions. You have been a part of multiple acquisitions. What do you know today? What do you know now that you wish you would have known that very first time?
Wow, okay, it's such a great question. And so here's the thing. I feel like knowing that, well, let me see, how do I say this? I feel like knowing when to walk away is super, super important. And we didn't walk away, so we wasted a lot of time and money and attention. And part of that is I wish I understood body language better. I wish we had an opportunity to really know when people are really, out there shopping and really not serious. And so I wish I would have known that. I think we wasted a lot of time with people that really just were not capable of selling, and it didn't work. And their body language would have told us that. There's a lot of things that were happening. So I think when you're getting to know people, instead of falling in love and looking for all the stuff you are looking for with your filter of what you want, you come at it in an objective way and look at everything they say objectively. And so I think that's a big thing. And we got to a point where we would write things down as we go, because we had a team, me and the CEO mostly, but sometimes there was a team and there was an integration team down the line we wanted to inform. And so we would write things down, and so we could keep track of what's really happening with all of the owner, the second tier management, all of that. So I wish I would have just been a little more savvy in that area. So I think that keeping an objective viewpoint is really important.
Yeah, and understanding people, because
yes,
relationships are everything, and people and that body language is huge. That's what's literally been the key to my success, is really honing in on the psychology of people, the physiology of people, what's happening, because it can inform so much more than their words. And so, Holli, as we talk about this, I've had so many other questions pop up, but what is a resource that our viewers can immediately dive into and start to learn about if they're thinking about maybe buying a business or adding acquisition strategy to their growth strategy? What would you recommend they look to educate themselves?
Well, I think to start with a really simple, bare basic book on how to do this, and Adam Coffey's the great. You know Adam as well. And he has 3 best-selling books. One is on private equity, and then there's an exit strategy, and then there's also Empire Builder. So I would say Empire Builder. That's his latest, greatest, and they're all bestsellers. And they actually teach you the nuts and bolts. And it is in there. And even if you don't want to know your numbers, inside and out, you want to hire somebody to do that for you, this book will help you understand growing and scaling in a disciplined way. Mm-hmm. And I think when you look at Adam Coffey, he's had $2.5 billion in exits and bought 58 companies. He is a very disciplined buyer. And so if you're going to sell your company, you want to know what those buyers are looking at. It will help you. It will help you build that business. That's what he did. So I think his book is really all encompassing. It's not a bunch of fluffy language. It's hard facts, practical.
Yeah, and you really can. I've read it several times too, and it's something that you can take and you can actually implement to get your business foundationally sound, because as Holli said before, you need to be foundationally sound before you add another business to your business and work with the integration process. Something else popped into my mind, because this is also happening right now. So many people are reaching out to me. I've got several clients who reached out to me because companies are calling them and wanting to buy their company. And then they go through this long, arduous process only to find out that they really didn't want to buy their company to begin with because they didn't even fit the bill. What if I'm fielding those, I'm getting these phone calls because I'm in, home services, which seems to be a very hot thing right now, and I'm getting all these people call me saying, I want to buy your business. How serious is this, and what should I be thinking?
I mean, it just depends on what your goals are. I mean, it's not serious. Okay, so you know it yourself. So it's generally not serious. They're just dialing to get people on a list. And so I would say if you are wanting to sell, you go back to what we said in the other segments where you prepare yourself for sale before you even answer a phone on private equity. I had a client do that, and the client's about $70 million, so they're not a small company. Private equity called them, they answered the line and said, yeah, I think it's time. Okay, no planning. They had done a system implementation that went bad, and so they had no financial information. And they somehow got through this due diligence very hard, and then it was very hard process probably for the buyer as well. But they're a great company, and they had made decisions that you wouldn't make if you're going to sell. They didn't know they didn't do a quality of earnings. They didn't know what their ebitda was. It was not good. They walked away from it, which was great because they would have left millions of dollars on the table. And I knew what their deal points were at the end, and they did not hire me to help them with this. So this was something that they're a client in a different way. And so now they walked away because they weren't getting the money. So it's like you need to strategize. Don't pick up the phone and go, yeah, let's do it, because oftentimes it's going to end in disappointment, and it's stressful. It's emotionally stressful to go through it, and it's hard for the accounting. It's hard on everybody. So do it with planning and diligence and discipline.
Yeah, and I just want to drive that point home because it is tremendously stressful, especially if you get to the letter of intent and you're in that final due diligence process, the last couple of months of it.
Yes.
It is it consumes your time because they'll ask for things and they'll ask for things and they'll ask for the same thing 6 times.
That's true.
So if you are not serious, if you think a fly-by-night phone call is going to end up in a result that you are going to be very happy with, you're kidding yourself. It is a tremendously long process. No buyer buys a business overnight. This is not like a real estate transaction on a home. This is a month-long process, and it goes into the fine details of everything. And sometimes you're having to drop everything you do. And if your business can't sustain itself while you do that, then you have no business selling your business to begin with.
And there is something called deal fatigue, to your point. And it happens both on the seller side and the buyer side. The LOI has been signed, letter of intent, and you're marching down the due diligence going on and on, or quality of earnings is going on, and both sides get burnt out, and that's what it's called. And so that is what happened with my client. They just got burned out and deal fatigue.
And the deal falls through.
Yeah.
And so you have to have your ducks in order. It's so critically important. So Holli, if people are listening to this and they're like, great, I want my financial house in order, or I'm thinking about exit, or I'm thinking about acquisition, you are one of the people who I often refer to from the financial side because you've been there, you've done that, you've got the experience. How can people reach out to you if they want to learn more, or if they want to maybe get some more resources from you so that they can enter this process?
Thank you, Jen. Thank you for that compliment. It's beautiful. So I'm on LinkedIn, and I also have my own website, and it's hollimoeini.com. It's HOLLIMOEINI.com, and I have my email and all of that on there. Just contact me, and I'd love to just have a free discussion about what you're looking to achieve and if I can help you.
Fantastic. And Holli, I'm a coach. You know this to be true, and I believe that knowledge is only a small part of the equation. The magic happens when we implement. So if someone is looking to get their house in order because they're thinking about exiting in 3 years, what is their action step today?
Well, they need to reach out immediately and get some professional help, because that is going to, unless they have talented people in-house, get some financial help, because what you really want to do is maximize your value. And so that is an accounting exercise, a CFO exercise, something that can help you go in there and maximize your ebitda, maximize your value, reduce your stress. So have your house in order will reduce your stress. And make sure you review your income statement and balance sheet, and everything's ready to go for several years back, at least 3 years back. We look. Sometimes people ask for 5, and make sure that house is in order 100%, and then they look going forward. And always honestly, the balance sheet always goes with the income statement. So if you're looking, you get the two together. Those tell the story. That's what you do.
Fantastic. Thank you so much for your expertise. I really appreciate you coming on and sharing your wisdom with everyone who is listening. Thank you.
Thank you for having me, Jen.
And you, yes, you, it is time to take action. You heard her here today. Holli does this day in and day out. This is what she's been doing for many, many years. It is time to get your financial house in order. If you haven't fallen in love with it, get the right professional so that you can know what's going on in your income statement and your balance sheet, because it's an epic love story about your financials. If you're thinking about exiting a business, make sure you get professional help. Get the right coaches, get the right legal expertise, the right financial expertise so that you can set yourself for success in transition. And if you're looking at acquisition, make sure you get your house fundamentally in order first. So incredibly important. You've heard it before, but today is the day you take action, not tomorrow and not next week. Take action on one thing you heard today to get your house in order and move yourself powerfully forward, because that is how we grow businesses. That is how we accelerate our success, and that is how we accelerate our impact. Unfortunately, all good things do come to an end, including this show. But the good news is we'll be here same time, same station next week. So until then, win today, win this week, and we'll see you next time.
This has been a Now Media Networks feature presentation. All rights reserved.